Jay, thanks for having me for this impromptu covered call writing conversation. You know, we spend so much time talking about tactical covered calls, volatility. Have we ever gone through an example of an actual covered call that we've written in the portfolio?
No, we haven't. And that'd actually be really impactful if you could go through one.
Well, let's just use Nike as an example because it's a stock that's had a lot of conversation behind it. And about 2-3 weeks ago, they reported their earnings, which just blew it out of the water. The stock popped 15% on a Friday on a very, very strong, unexpectedly strong earnings announcement, even from our perspective. That's a fun problem to have if you don't have a covered call on a position that goes up 15% in one day. So on that day, we wrote a covered call. The stock was trading around $154 after the pop. We wrote a covered call for 3 weeks out, $165 July Nike expiration. And we brought in about 75 cents in premium. Now that doesn't sound like much, but if the stock was to go up to that 165 level and get called away from us, it still would have been another 7 or 8% upside. If it doesn't, if it stayed flat or went down, the premium that we generate, that 75 cents, which also doesn't sound like much, annualizes out. If we were to do it every 3-week cycle, which we don't do, but if it annualizes out, it would annualize out at an 8% income stream. So that 75 cents becomes very, very powerful. Now, just last week, we took that call and we rolled it up to an early August expiration, August 6th. So we actually bought the call back to close. We wrote another covered call for August 6th, which is a very short period of time. Same strike price, $165, but we brought in a net $2.05 on the entire trade. So now you're sitting here and you're saying, so that trade was about a $1.30 in pocket plus the 75 cents we had before. There was a little cost in buying back the other option. But here we sit today with $2 in our pocket banked from having written covered calls on Nike twice. Now the stock's trading around $157 a share. If it goes to 165 and we get called, again, you get that pop in the upside capture. We keep the premiums that we've generated. And it's not a huge dividend, but by the way, let's not forget it pays $1.10 a year in a dividend as well. So in a perfect world, we come to August 6th, stock's trading at $164. And again, in perfection, we don't get called. We've captured all that upside. We've got the premium and we'll get our dividend. And then we live to fight another day and look and see what the rest of August brings us. But covered call writing might not sound like a fortune, but if you do it all the time, it sure adds up.
Kevin, that's a great example.
Thanks, Jay.